Today, we will talk about dividend policy. A dividend policy is a policy a company uses to structure its dividend payout. Put simply, a dividend policy outlines how a company will distribute its dividends to its shareholders. These structures detail specifics about payouts, including how often, when, and how much is distributed. There are three different types of dividend policies: stable, constant, and residual, each with its own benefits. Dividend policies aren't mandatory, as some companies choose not to reward shareholders with dividends. Having a dividend policy in place is important for dividend-paying companies. Some companies choose to reward their common stock shareholders by paying them a dividend. A dividend is paid on a regular basis and usually represents a portion of the profits that these companies earn. This gives shareholders a regular stream of income, which is why dividend-paying stocks are a favorite for some investors. A stable dividend policy is the easiest and most commonly used. The goal of this policy is to provide shareholders with a steady and predictable dividend payout each year, which is what most investors seek. Investors receive a dividend regardless of whether earnings are up or down. Under the constant dividend policy, a company pays a percentage of its earnings as dividends every year. If earnings are up, investors get a larger dividend, and if earnings are down, investors may not receive a dividend. With a residual dividend policy, the company pays out what dividends remain after the company has paid for capital expenditures and working capital. This approach is volatile, but it makes the most sense in terms of business operations. Kinder Morgan shocked the investment world, and in 2015 it cut its dividend payout by 75%, a move that saw its share price tank. But many investors found the company on solid footing and making sound financial decisions for their future. In this case, cutting its dividend actually worked in its favor. Dividends are paid by companies to their common shareholders. They represent a portion of the corporate earnings or profits that companies want to share with their investors. Dividends are paid at regular intervals, either monthly, quarterly, or annually. Dividend-paying companies have several options when it comes to the type of dividend they offer shareholders. They can pay dividends in cash, which is the most common type, or they can offer stock dividends, give shareholders additional shares in the company. No, not all companies pay dividends to their shareholders. A company's board of directors decides what to do with its profits. Some choose to reinvest the money they earn back into the company to fuel growth. Others choose to take a portion of the profits and pay dividends to their investors on a regular basis. Dividend-paying stocks can give you a steady stream of income while adding value to your portfolio. But before you jump in, make sure you review the dividend policies of certain companies. Here are three key takeaways. 1. A dividend policy dictates the structure of a company's dividend payout. 2. Stable, constant, and residual are the three types of dividend policy. 3. Even though investors know companies are not required to pay dividends, many consider it a bellwether of that specific company's financial health. Hope this would help. Thanks for watching.